Most people think finance is about numbers, reports, and accounting. That's surface level. The real game in finance is about managing uncertainty, understanding risk, predicting what might happen next, and preventing losses before they occur. And that's exactly where financial analytics comes in. It's not just about tracking money, it's about making smarter financial decisions using data. Think about this in a simple way. Imagine a bank giving out loans. If they approve everyone, they grow fast, but risk massive losses when people fail to repay. If they reject too many people, they stay safe but lose business. So how do they decide? They analyze data, credit history, income patterns, spending behavior to estimate the risk of default. That's financial analytics in action, balancing growth and risk using data instead of guesswork. This approach didn't appear overnight. Early ideas around risk and probability were shaped by thinkers like Harry Markowitz, who introduced modern portfolio theory, showing how risk and return can be balanced using mathematical models. Over time, these ideas evolved into complex financial systems that rely heavily on data and analytics to guide decisions. In practical terms, financial analytics operates in three major areas. First, risk analysis, identifying potential losses, whether it's loan defaults, market crashes, or fraud. Second, forecasting, predicting future revenue, expenses, or market trends based on historical data. And third, fraud detection, spotting unusual patterns that indicate suspicious activity. For example, if a credit card suddenly shows transactions in multiple countries within minutes, systems flag it instantly. That's not manual work, it's analytics running in real time. And this is where scale changes everything. Companies like JPMorgan Chase process millions of transactions daily. There's no way humans can monitor all of that manually. Analytics systems track behavior, identify patterns, and trigger actions automatically. A small improvement in fraud detection or risk prediction can save millions, sometimes billions. But here's the uncomfortable truth. Financial analytics is not perfect. Predictions can be wrong, models can fail, and markets can behave unpredictably. Over-reliance on models without understanding their limitations has led to major financial crises in the past. That's why analytics must be combined with judgment, not replace it. Now with AI, financial analytics is becoming even more advanced. Systems can learn from new data continuously, adapt to changing patterns, and make decisions faster than ever. But this also increases complexity and the risk of mistakes at scale. That's why understanding the fundamentals still matters. At the Learning Studio, the goal isn't just to explain finance, it's to show how decisions are actually made under uncertainty. Because once you understand financial analytics, you stop seeing numbers as static reports and start seeing them as signals of risk, opportunity, and future outcomes. And that's when you begin to think not just like a user of money, but like someone who understands how it's managed.